Hey everyone, it's Imran from Options Insight, back with another one for you. Okay, interesting phenomenon going on in markets right now. So over the last week or so, we've seen a crash in correlation. So what is correlation? Correlation is whether stocks are moving in the same direction or whether they're doing different opposite things. Okay, this tends to happen when there's less systemic risk in the market. So generating returns in markets becomes more about a stock picking game than picking the macro direction when correlations are falling. Okay. However, right now, I think it's pretty clear that macro still matters. Okay. I mean, we've got the FOMC coming up. We've got, inflation potentially still, not going away. We've got CPI next week. So I don't think macro is falling off the map, but yet correlations are collapsing. So why is that? So looking at this chart, you can see 1 month and 3 month correlation have fallen off a cliff in the last sort of week or two. Now, this can also happen when there's large spread trades in the market that are being unwound in a market that's not liquid enough to really digest it. Okay, so we know people have been short regional banks and Russell. We talked about that yesterday. That started squeezing, but yesterday we started seeing tech getting sold as well. So we're seeing tech down 2% and Russell up 2% on the same day. We know that's been a big trade that's done really well for people who are in it, but now they're starting to feel the pain. Okay, so that's what's going on here. So we don't think this drop in correlation is necessarily a healthy thing for the market like it has been in previous episodes. And there is also some precedent for when correlations absolutely just crash, that can also be a precursor to a bit of a low in vol and a bit of a top in the market. Okay, when we talk about a low in vol, it's because that high dispersion between the different sectors and stocks means that the broader index doesn't move. So the S&P hasn't really moved so much, which is why the VIX has stayed low. And if you look at the term structure on the VIX, that's back into a very, very steep contango, which is a bit of a sign of complacency. Okay, so need to be aware of that and know that when we're in this state, it's often pretty close to a short-term low in vols, and therefore putting on some hedges, putting on some downside type structures might make sense given what we're seeing with these metrics under the hood. Okay, now jumping over to our vol dashboard, looking at yesterday's price action, stocks retreated. Obviously, we've already said the tech sector finally saw some profit taking. Yields were soaring higher. We had the Bank of Canada hike rates, which was kind of expected, but they guided quite hawkishly as well. S&P obviously couldn't get above 4,300 and has rejected that area. Mid caps, like we said, have outperformed. And we think that's because this NASDAQ Russell trade is to some extent getting unwound, at least in the near term. Gold was hit on the higher real yields. That was down around 1.2%. And then energy was actually quite strong. Bit of anticipation of a strong summer demand for oil with driving season. Dollar was pretty stable. Bonds sold off, however, with the July FOMC pricing a more probability that we're going to get a hike. And there is some probability there as well that we might even get a 50 basis point hike in July if needed. Looking at skew, equity skew was mixed. We saw higher skew in S&P. We saw much lower skew in Russell. Russell skew was basically smashed down to the lows. Obviously, we have rallied 8% in a week. That's pretty punchy. China skew also down. Bit of a misprint on this vol though. It wasn't quite down as much as it's showing here, but it is lower. So something there with China deposit rates being cut by state-owned banks, looking like signs of support there. So people may be thinking the upside in China is still worth playing. And then put skew in metals also catching a bit of a bid as spot does remain quite weak. Okay. Now, in terms of implied vols and carry, US vols found some support. NASDAQ actually the best, given that it was down 2%-ish. VIX, however, like I said, staying at 14 as it's really a rotation rather than a broad market move. Carry still deeply negative across the equity indices here. Energy vols coming down about 1.5 to 2 vols there, down 7 points on the week. That's a pretty punchy move in energy vol, taking USO down to the low 30s again, where it tends to kind of find some support. FX vols were actually drifting lower. We highlighted FX vols as cheap, but they are grinding their way lower still and back in positive carry across the board. And then in terms of bonds, we saw some support in bonds vol, even though it's got positive carry still. But we did see quite a big thrust lower in terms of TLT, down 1.5%, as we said, with those yields moving higher as the Bank of Canada hiked rates. Okay, what else? So really we're focusing on this kind of collapsing skew on the Russell. Okay, so obviously shorts are getting covered. 8% on a week was a 3 sigma move for the Russell. Futures positioning, as we showed in yesterday's daily note, is kind of more neutral now. And it's clear that position unwinding is happening. But we think maybe using this squeeze as an opportunity to re-enter shorts might make sense here, at least in the near term. The skew in Russell has been crushed to 2-year lows, and that's not just the 25 delta skew. If we look at wider risk reversals like 10 delta, far out of the money stuff, you can see here it's kind of collapsed as well, back down to 2-year lows that haven't been seen since October last year in the Russell. Okay, so whilst it might be too early to fade the rally, there might be some more upside. If we look at the chart on IWM, which is the ETF on Russell, we do see quite a big resistance up at 204, and we're trading at 188 now. So maybe we push to the next level, but for us to really get all the way to 205 and through that would be seriously surprising to us. And we think fairly unlikely, given that a lot of the positions in the futures are kind of getting squared now. Okay, so we're thinking, maybe we use more far out of the money calls as a funding leg to buy some downside, to play the idea that this squeeze is getting a bit long in the tooth and may well reverse over coming weeks. And that would be a way to fade it, basically. Okay, you look at the strategy compass. It is obviously just saying buy puts. So if you're not comfortable selling calls, just buying puts on Russell is kind of looking fairly attractive here. And we have got negative carry, right? So that suggests, but remember, we've had very big upside days. The downside days haven't been very big. The upside days have been massive. Okay, so we have got a negative carry here, but vol still at 19, and we've got VIX at 14, and we've been in what we would call a pretty low vol environment for some time now, and we are heading into the summer. Okay, so how do you feel about just buying a load of more premium? Like, we have been pitching quite a lot of long option ideas lately, and we've been saying be very selective about which of these ideas you pull the trigger on, because just blindly buying premium all day long is probably a losing game right now. Okay, so you got to make sure you align how much premium you put on the table with your conviction against various bets that you want to take. All right, that's it for today's one. I'll catch you all tomorrow. Cheers.